Hello everyone. Good afternoon and welcome to the Hindu Business Line webinar. We have with us Ms. Radhika Gupta, MD and CEO of Edelweiss Mutual Fund. Hello ma'am.
Hello,
Welcome.
thank you for having me.
Welcome and thank you for taking time to share your insights, ma'am. Uh,
My
so we,
pleasure.
yeah, we are living in exceptional times with tariff wars and geopolitical wars making their mark on investment outcomes. Today, we plan to discuss about the risks and opportunities amid such global turmoil. But before that, for our audience, let me introduce our guest. Most in the investing world must know of her, but let me properly introduce her. Ms. Radhika Gupta is a Wharton graduate. She is a hedge fund manager, an entrepreneur, and also an author. She recently authored her second book, Mango Millionaire. We'll also discuss about that for the benefit of the audience. Ms. Radhika Gupta is a co-founder of India's first alternative investment boutique, Forefront Capital Management, which was later acquired by Edelweiss. Now she heads Edelweiss Mutual Fund, which has assets under management of 1.5 lakh crore. And that has been a remarkable journey since the time she assumed the role. So without any delay, let's get insights from the leading investment professional of the country. So ma'am, before we get started, in your own experience, what is a prominent feature of the last 5 years in Indian equities? They from valuations to stock rallies and corrections. What is it that you would like to highlight in the last 5 years?
So, I think a few things. I mean, it's been a seminal period for the Indian equity markets in that sense. And I think there are a few themes, both from a stock market point of view and an investor participation point of view. Firstly, I think the whole theme of financialization in India and the number of investors that have participated over the last 5 years in the market, the way equity investing is becoming absolutely mainstream, I think has been a very distinct feature of this rally. And I think a combination of awareness, digital mediums, access that is provided has made equity accessible. So the equity story now is gaining a lot more confidence. I think people's understanding, they see the Indian economy, they see companies in action. So the arm janta's confidence in that sense in equity markets, in their desire, their level of risk, their aspiration to participate in equity markets, has been defining. It also, I think, has changed the way capital flows have happened, because for many, many years, till past rallies, and if you look at past corrections like 2008 and even the COVID correction, FIIs would pull out 40, 50, 60,000 crores of money, and markets would suddenly fall 25, 30, in 2008, 50%. The falls because of the fact that domestic capital today has become more powerful. If you look at retail investors plus mutual funds, domestic institutional investors, we are actually, I think, close to 24% of the market, now larger than foreign institutional investors. So the market has acquired what I call a little bit of this Teflon coating, which means the falls are sharper. In fact, many of us joke that you've not really had a fall in the markets since 2013. That has been a 1 year prolonged fall where you could really think and deploy capital. The falls have come, but they've been much shorter. And I think it's because of the presence of domestic capital, 27,000 crore SIP book. Um, I think if you look at the market microstructure, markets have meaningfully expanded. Small and mid caps today, from accounting for maybe 20, 30% of market capitalization, now account for 40% of market capitalization. The listed universe that is available to investors has widened. And I think the last thing I would say is the number of sectors and subsectors that an investor really has to look at, and the options out there have widened. If I look at my own field of financial services, when a financials analyst covered markets, they used to cover banks and NBFCs. Today they cover bank and NBFC, but there's a whole spate of depositories and exchanges and asset management companies and life insurance and general insurance. So you are really seeing an emergence of a wide number of listed companies. And with the burgeoning IPO market over the last few years and the fact that India is still an emerging economy, I think the listed universe in terms of the variety out there is going to meaningfully expand, and you'll see some very new business models.
Okay. Anything on the, you have explained, well explained on the supply side, but on the market itself, equity market itself, has there been a change, noticeable change in the last 5 years?
I think from that point of view, the core of the market, which I wanted to mention and forgot till you reminded me, is that there are two drivers of market returns. One is really multiple backed re-rating, and the second is earnings driven drivers. If you look at the previous decade and equity markets in previous decade, it was a combination of earnings backed growth and multiple driven growth. If you look at the last 5 year kind of rally that we've seen in the market, earnings growth has been a very, very meaningful driver. So you are seeing corporate balance sheets in the best of shape. In fact, one would argue not enough lending has happened if one had to be critical. One would see corporate ROEs have gotten better and better. So you're talking about double digit ROE. And the profitability that corporate India has had is improving, and we're plowing back the profitability to also keep our balance sheets. So from a health of company point of view, actually companies are looking better than they are before. What is critical for the market rally to sustain now that valuations are not cheap, is to see this consistency of earnings growth.
Okay. Yeah. Coming to the current times, at the front and center is the tariffs question. So,
Yeah.
so as an institution, how are you factoring the tariff conversations into your approach to investing? You can highlight anything from time frame of the impact to the sectoral impact. So how are you addressing that important factor?
So I think there was a very major regime change, and this is what we believe at a portfolio level in 2000, in October last year, where you really saw the world go from not very much volatility to all this tariff-induced volatility, compounded, of course, with some geopolitical volatility. Now, as investors who manage public money, I think there are a few things we do. One, we realize this volatility is not going away. Yes, we believe to some part some of the noise around tariffs and how it will be played out has been digested by the market. So, quarter one and quarter two were exceptionally volatile. But now the fact that the tariff, when it's announced, is not, it's the beginning of a negotiation process. Let me put it that way. So, one Twitter announcement should not make the market nervous, because finally there's a negotiation process that happens. There are trade deals that work out, there's give and take that happens. So, I think one, there's a realization that there's a negotiation process and the market is digesting the tariffs. Although August 1st is going to be a very, very important uh, day as we come to it, because it is a critical week. Now, at this time, given that there is so much uncertainty, what do we do as investors? We try to reduce the amount of sectoral deviation our portfolios have take. So we don't take large sector calls, overweight or underweight the benchmark. And let me tell you why. Today, IT could be under fire as a sector because of a lot of tariff induced uncertainty. Tomorrow, if the tariff induced uncertainty goes away because of some negotiation, suddenly IT is rallying. Pharma as a sector has been in the news for tariffs, and there's tremendous uncertainty around pharma. So we try to not take very, very strong sector calls because we see the uncertainty. What we try to focus on and our energy on more as investors is stock selection. So the bulk of our time is not going in and identifying which sector to be 20% overweight or 10% overweight, but to play the names in those sectors. The second is we tend to be more inclined in these times to domestically biased businesses which are less impacted by the tariff. So even if we are looking at healthcare as a segment, we'll try to avoid companies with a strong US business and focus on India hospitals, where we believe that there is a meaningful under-penetration story, and that's not going to be colored by what is happening with tariffs. So one, not too many wild sector calls. Secondly, being a lot more focused on domestic oriented businesses.
Okay, fair enough. So, what essentially you're saying is that uh, you think this is a long process, and the sector focus may be too premature for, is what you're saying.
And it is very hard for us, you know, to make it's very hard for geopolitical global leaders to take a call on which way the tariff war or tariff talk is swinging. So I think it's important, far and for us even harder. So it's much more important to let the process play out, calibrate the risk that you can't take, and focus on the risk that you can take well.
So there's also this a lot of narrative on the shifting supply chains across the world and how India can benefit from such shifts. And we have seen early indications in electronics manufacturing and to an extent in pharmaceutical research or chemicals. So is this narrative worth investing into, or one needs more traction to get behind it?
So I think the narrative makes for a starting point, but one can't be blind by the narrative. I think one has to be nuanced. So if you look at the narrative around China plus one, I do think there is a narrative around diversifying supply chains. That's valid, uh, but it would be a little unfair to think that China plus one is only India. China plus one could also be Vietnam. China plus one could also be Mexico. So we are one beneficiary of China plus one, but we are not the only one. Now, in some sectors, and to give the government credit where it's due, I think there has been a conducive policy environment around manufacturing in India. In particular, I think PLI as a scheme has been reasonably successful in some sectors. The critical thing is now to identify the sectors where, despite our land and labor constraints, because of policy, because of demand, we have the ability to execute. So, mobile phones, for instance, have been a major success. I think EMS and a number of the EMS companies, the kind of investments that have been made into India, have been a major success. Chemicals or textiles, I'm not sure if it's been such a major success. So, I think the narrative makes for an interesting starting point, but then you have to look at the nuance.
There's this factor at the back of the mind, but the actual credible evidence is still a little far away, is what you're saying. And also, like you said, there are other players like Vietnam who are also competing along the same lines as India is doing. So, coming to defense sector, ma'am. So, post Operation Sindhu, do you believe defense is a sector that stands on its own now, not as a subsector of PSU or capital goods? And how are you seeing the evolution? Is that a space that interests you right now, or you're waiting for better valuations?
Actually, well before Operation Sindoor,
Hmm.
we had looked at defense and, had meaningful positions at different points in time in defense in our portfolio. I don't think our decision to look at defense has been triggered by Operation Sindoor. I think it was probably about 3 4 years ago that we started looking at defense as a independent sector or a subsector as part of the capital goods sector, and our thesis was reasonably simple. uh, Indigenization of defense is a meaningful theme, and it's a commitment that the government has talked about. It's a sensible commitment because if you look at India's defense spend compared as a percentage of GDP, compared to both the US and major markets like China, it's lower. So I think defense spending as a percentage of GDP, we believe, has to rise. Factor number one. Second, if you aspire to be the third or fourth or second largest economy in the world, you can't be importing Rafales, sustainably and consistently. So, indigenization has to be a very, very important play. And now you have meaningful defense companies in India. And what we've seen over the last few years is not just in terms of indigenous demand, but defense exports are well over 3 billion and growing rapidly. So I think this actually forms the basis for our defense thesis. And, Operation Sindoor happened to happen. And we saw the capability of some of those defense systems, including locally made air defense systems, for instance, which were a very integral part of Operation Sindhu. Now, this thesis kept in mind, At any point in time, we have to look at a combination of the long term and the short term. And when we look at the short term, we also have to look at valuations, converting order book into PAT and bottom line. So that's why I said we've held defense at various points. Structurally, we've been very, very bullish on the thesis, but our positions tend to move up and down because we also want to pay realistic multiples. When a stock is 100 or 120 PE, then you really have to justify a lot of growth to make money. So that's the balance that we're trying to find.
Okay. So yeah, then again, the narrative is there, but the valuations may be a kind of a hindrance at the moment. So on a broader scale, ma'am, if we look at government capital expenditure, in the
Mhm.
last 5 years, you would have also witnessed that the government capital expenditure has risen by 27% CAGR to 11 lakh crore.
Yeah.
Now, if one were to assume that the growth rate at least may taper down, even if the absolute number doesn't, even if the growth rate tapers down, so you think it leaves a vacuum, and does the private capital expenditure can take the task on? And also, what is the clarity that the industry needs for to set up the next round of capacity? Because there seems to be a holding back of private capex.
It is a bit of a chicken and egg kind of issue. So on one hand, yes, you have had government capex, and we've seen a very fast pace of growth of government capex. And I tend to agree with you that while the pace of growth may slow down, the fact is even government capex continues to grow. And so we have a healthy rate of capital expenditure, infrastructure expenditure that is happening, and I think that is a good thing. Now, as far as private capex is concerned, I think there are two things that are worth thinking about. One is private capex. Yes, government has done the heavy lifting on capex, and private sector has to take it on. One is I think that private capex also responds to demand, and one of the things that we have seen is muted sort of consumption demand that has happened. That is also a reality that we can't go away from. Um, I think one of the better things that happened in the budget this year was the large tax break that a significant amount of middle income taxpayers were given, which leaves more money to consume in their hands and hopefully also a little bit of money to invest. If we start to see that consumption demand come back, then hopefully the private sector will, react to that, and you'll start to see that. So that in that sense, it's a bit of a chicken and egg situation. The private sector responds to demand. The second is, I think, we have seen a lot of brownfield kind of projects happen in terms of capex. But is anyone putting up serious greenfield capacity? I think that's something that we need to think about. We've now seen the FM telling industry and telling banks that people need to go out there and lend, people need to put up private capacity. But I think a little bit of concern is there on building and doing fresh greenfield capacity.
Okay, so you don't think the tariff conversation or the geopolitical volatility is also a factor that is holding back the companies, because the tax announcement was done.
Mhm.
So at least one part has been, there's a clarity on that, there's an encouragement on that aspect, but still there doesn't seem to be pick up. So are the international factors are also a factor?
So I would say two things. One is that the the lethargy in private capex happened well before the tariff tantrums and some of the geopolitical volatility. I think if you look at news and conversations, the conversation on private capex revival has been a one that we've been having for 2 3 years, well before all of this tariff stuff started. So can it add to it? It can potentially add to it. It can add to uncertainty, but I can't blame it's the sole driver. The second is while the tax break announcement has happened in February, remember we've only had 1.5 quarter since it's happened. So for the benefits of the tax break to flow into a consumer's wallet, for the consumer to start changing savings patterns, investment pattern, consumption pattern. Our suspicion is it is going to take a couple of quarters. So at least our belief is that if you look to the second half of this financial year, particularly after the festive season, maybe then you will start to see some tweaks in demand start to happen, but it will take some time to flow through.
Okay, we'll stay on this consumption thing. So, domestic consumption is showing pockets of weakness. First,
Yeah.
it was the cited in rural side of the market, and then they started saying urban side, and now the IT companies are also announcing layoffs and all.
Mm.
So, combined with your earlier question that this lethargy started 2 years back,
Yeah.
because there were no signs of real growth in consumption. So, what are your thoughts on consumption trends in the country? Is that a serious headwind?
So, in the long term, a significant part of India's GDP is consumption driven. And if per capita income has to expand from 3 or thousand today to closer to 10, 15,000 by the time we are talking about Viksit Bharat. And if you look at the patterns the US has seen when consumption has expanded the way it has, then it's inevitable that consumption in the medium term, I mean, India has always been a consumption driven economy. I think we've talked about rural slowdown, but we believe rural is actually starting to come back. I think the challenge we face now is urban consumption. And the interesting part is that consumption is actually very K shaped in India. So there is a part of premium consumption, uh, consumption of cars, consumption of events, consumption of food delivery, uh, hotel capacity, where actually you're not seeing a very, very meaningful slowdown. And then there is a part of discretionary consumption. I think, one of the companies reported a laggard behavior in toothpaste. So I think consumption in the Indian context has also been K-shaped. The second is, I think, how we measure consumption needs to be thought through, because typically the way consumption was measured was your traditional kirana stores, traditional sources of consumption. I think there's also a shift in consumption behavior to parts of consumption that are less measured. Like if there is a shift that is happening from your physical consumption to your e-commerce driven consumption, I'm not even sure if that completely gets measured in India's consumption basket. But the reality is that there is K-shaped behavior in consumption. One part is hurting, and one part is growing well. I mean, there's an interesting take on IT. You mentioned the IT slowdown. If you look at IT leadership compensation over the last 20 years, it's actually gone up. If you look at the salary of the top level guys in IT, even an ex-ESOP, that's meaningfully gone up. If you look at the salary of an IT fresher, forget inflation adjusted. I think in 2000s it was 3, 4 lakhs. It is still 3, 4 lakhs. And that just tells you where we are. And inflation adjusted, by the way, that number, that 3 lakhs should have been 8 to 10 lakhs.
Okay. So, uh, okay. So, can we move on to sectors, ma'am? Like
Yeah, go for
right
it.
now, uh, can you highlight the sectors that are most interesting right now, and also the sectors that are not, and for what reasons are you thinking as such?
So, firstly, I think, you know, given the environment that we are sitting in today, and just I'll answer the question, but just a little bit of word of advice to investors. I think investors want to be very, very dynamic in their sector choices. And we have always been a believer that India is not structurally a single or two sector economy. It is very, very much a multi sector economy. And those opportunities rotate through the years. But structurally in India, we believe investors should have diversified portfolios. It's a very, very strong conviction that we hold. And sector selection is hard for people like us. It's even harder for individual investors. And sector rotation is very, very sharp. If you look at the sectors that led the market rally last year, manufacturing and capex, they've been the laggards of this half of the year. If you look at the sectors that were in the dumps last year, a lot of financials. They've actually done relatively better in this half of the year. So I think sector tilts are very, very difficult. And our approach is also reasonably dynamic. Now, if you has to ask me a couple of thoughts, there are three interesting areas that I would talk about. One is the whole space of hospitality and hotels. We believe that air travel has significant under penetration. If you look at the kind of capacity that India has on hotel rooms, even versus China, it is probably one tenth China. For our size of populations, we don't even have 1 million hotel rooms. I think China has about 9 million hotel rooms for their population. We have 400,000 hotel rooms. And, particularly in smaller markets, in tier two, tier three cities, as business travel increases, as luxury travel increases, as religious tourism increases, you don't have meaningful hotel capacity. A city like Kanpur, and I visit it frequently, yet doesn't have a single five-star hotel, maybe not many four-star hotels either. So hotels as a sector is one that we believe is a very, very meaningful story of underpenetration. The second is organized hospitals. You'll have unorganized beds, but in terms of the number of beds we have per thousand people in India, it's very, very small. For a population of 140 crores, we have hospital beds in a few lakhs. Again, much smaller numbers compared to US and China. And with the increased focus on healthcare, with necessary government policies, more life and health insurance penetration that people have, I think hospitals is a very, very meaningful story. There are listed players in that segment. And the third one that we believe is a very interesting long term theme, and we started this conversation by talking about it, is capital markets. We believe financialization is an inevitable part of India's growth story. The movement of household assets from physical assets to financial assets. You're already seeing so many articles being written about the fact that deposit growth is significantly slower because people are choosing to park that money in new demat accounts and equities or mutual funds or other forms of financial assets. So the whole space of capital markets that includes wealth managers, brokers, asset managers, exchanges. So hotels, healthcare, and capital markets.
Okay, so I'll have some follow-up questions, ma'am. This story of under-penetration, this has been a constant theme. So will that crystallize into a meaningful change going forward? And what is the trigger for to assume that the under-penetration will change into a significant earnings drivers in the
So I
future?
think I think under penetration in Indian, I mean, if you look at India's numbers, household savings that go into equity are today about 7-8%. Mutual fund penetration, just as a measure of under penetration as a percentage of GDP, when I started in this industry was 5-6%. Today it's 20%. If you look at where global markets are on average, it's about 80%. So under penetration is real, and under penetration is there at levels which are very, very meaningful. As long as you have per capita GDP growth, say, $2,500 to $3,000 is a very interesting point in a country's per capita GDP income history. Um, and you should see China to see how this played out and how it may play out. But it's the point at which आपकी जो basic needs होती हैं, जिसको हम रोटी कपड़ा मकान कहते हैं, they are done. And you start having incremental income that goes into either consumption, discretionary consumption, and a lot of it goes into savings and investments. The second is, over the last 20, 30 years, India has also transitioned from a high interest rate to a much more moderate interest rate economy. And that's why banking and traditional instruments are not as much an option as seeking returns through capital markets. Today, the post tax fixed income return for someone is 3-4%. It's a very, very small number. It's not even beating inflation. So I think as long as per capita income continues to be where it is, as long as there is not much value in post tax yields on fixed income, you will have no choice but to look at capital markets as a source of growth. And how will that growth come into the economy? In very, very many ways. I mean, capital markets in itself comprises so many different subsectors. So you will see more asset managers, more insurance companies, more wealth managers being listed and becoming large companies. You'll see these people be capital providers to newly listed companies. I always say that if someone wanted to raise capital in 1990, India was a bit of a capital deficient nation. You didn't Bank debt was expensive and hard to find, and you didn't have developed equity markets. And over the last 30 years, you've seen an equity culture rise, you've seen foreign capital come into the country, you've seen the formation of domestically backed mutual funds, AIFs, private debt, venture capital. Today, if someone is young and has an idea for a startup, I promise you, they will not be short of capital. And that's how capital markets are pulling back into the economy.
Okay, so we started the conversation with a flux, stating the point that there's a flux of retail capital that is flowing into capital markets. So just tying it back to one point, one observation you had, key since 2013 we didn't have a serious correction,
Yeah.
the kind of correction that capital markets generally experience. So you think this flux of capital will weather any eventual 20% correction?
So,
Structurally, will they stay back, or this fresh capital will
so
find
it's
its, yeah.
look, it's a good question to ask. And I think the answer is a mix. Now, there will be some, I agree, the capital that has entered the market over the last 5 years has not seen too many prolonged corrections. It's seen corrections, but it's not seen too many prolonged corrections. And some of it, of course, will see that 20-30% portfolio correction. Some of the people will gamble away money on F&O. They'll be scarred and they won't stay. But I think within this capital that has come into the market, there are really two kinds of capital. There's capital that has come in, that is investment capital. I think that is mostly long term capital. It's come by ways of SIP, and I promise you, if you do a 5 year SIP in any decent fund, forget ours, you don't have bad outcomes because there is an averaging that happens. So if it is productive capital, if it is investment capital, I think a large part of it has the ability to weather the storm. If it is speculative capital, then I ask a lot more questions. So all this noise about retail investors who lost money in F&O, do I think a part of them will be burned and not come back to the market? Almost certainly. And when you're participating via F&O, you can also lose more capital than you've put in the first place, which in itself is a very, very prickly situation. I mean, one test of this look is that the industry's SIP book has been growing, the mutual funds. And every time there's a correction, I'm almost always asked, "Acha, yeah, SIP book, this will go away. What will happen to it?" But so far, it's been reasonably resilient because I think structurally, the way India invests has changed. Now, if there's 20-30% froth on it, then so be it. And I think that froth will come from the speculative part of capital, hopefully not the investment part of capital.
Fair enough. So we'll move on to a few of the subscriber question, ma'am. And this question probably you're the best one to answer. Is the current RBI restriction on mutual funds to invest in foreign securities shielding Indian retail investors from the global crisis, or are Indian retail investors losing out on cheaper markets abroad?
Well, look, it is the restriction, the performance of global markets is like the performance of Indian markets going to go through its cycles. And I run multiple global funds, which is perhaps why I get this question. I run a fund that is investing in China. And we have seen periods where China has done extraordinarily well. And we have seen periods where China has done extraordinarily badly, like India and all other markets. We have a fund that invests in Europe. And I promise you, एक साल पहले तक किसी ने उस fund को छुआ नहीं था. And in the last year, it's the best performing international fund. So we have a flux of investors that are coming in. Now, if you ask me my advice on this, I think global investing should be a part of an investor's portfolio if you are a mature investor. This is not something to experiment with if you are a new investor or a first time investor, because first it's important to develop comfort with local market. क्या होता है ना, अपने लोकल मार्केट में कुछ हो जाता है, कुछ गलत हो जाता है, यू डोंट फील एज कंफ्यूज्ड बिकॉज फाइनली यू आर familiar with the country, the politics, the economy, the companies, etc. But when something goes wrong in China or Europe, you get very nervous. So I think international investing should not be looked at as yes today, no tomorrow. For instance, in my own portfolio, maybe 10 for 15% of the portfolio is always in international funds. Now, yes, there are RBI limits coming to the question, but some funds, I mean, our own funds are open so far, and I know some other industry funds are open. There are also other ways that some of us are creating for people to participate in those markets by a gift using the LRS limit. It's not rupee capital, but it is dollar capital. So I think options still do exist today, maybe not as many as you'd like.
And is the AMFI in talks with the RBI to work around the ban on overseas investment?
Of course, I think all of us have had multiple conversations with, various ministries and regulators requesting their good offices to relook at this limit, because I think the last time this limit was reset was 2008 or 9. And hopefully, in due course, they'll pay heed to it.
And on the point that is it shielding? Well, it was shielding till last year, and this current 6 months,
That's what
maybe
I'm
the
saying.
global markets.
The answer to this question depends on when you ask me the question.
Okay. So this is a okay. How will the trade deal with US affect our economy? As my perspective is, if every country is paying the tariff, then what is the effect on in our export? So
So I
yeah,
think,
I'll just clarify that question
yeah,
in
go
case
ahead.
it is not clear.
Go ahead.
So essentially, if everyone is paying the same amount of tariff, how
Uh-huh.
will that create a differential opportunity or a risk?
So I think, well, it's early to talk about the US trade deal. I think we can take some inkling from where the India UK trade deal has been struck. And I do believe in a select set of sectors. That trade deal is supposed to actually do well for India. So, in terms of lower auto prices, in terms of imports here, wider export basket. See, if you look at India today, we don't have a very meaningful amount of exports to the US outside of two things: pharma and IT. Now, could this create a more meaningful opportunity for Indian manufacturing? Perhaps. To your question, if everyone's taxed the same, then we are all in the same boat. But if you are able to, now with the tariffs, actually this question is all relative. So it depends, and the US is negotiating trade deals with many countries. It really depends on where you finish in the relative pecking order.
Okay. So we the other question is how exposure to capital heavy FPI hurts our stock market, or would you even agree that it hurts, or how would you see that
Is the
flows?
question that is a large amount of FPI participation bad for the markets? Is that the question?
Yeah, I think that is a question. Yeah.
Yeah, that's my. So I think what FPI, there are two kinds of foreign capital that come into India. One is FDI capital, and the second is FPI capital. I think FDI capital, foreign direct investment, which is people placing long term bets in underlying businesses, what Apple is doing, what Foxconn is doing, many others are doing, what Uniqlo is now going to do in MP, many other such stories. That is actually very good capital for India. It's foreign capital coming and making long term structural investments in building out businesses in India. So, if Uniqlo, which is a Japanese company, has decided that they're going to put up a lot of plants in MP, do everything from manufacturing to cotton cultivation and build that whole value chain in India, that creates jobs, it creates opportunities. That's fantastic capital, and it can't be pulled out very quickly. FPI capital, while it's welcome, also comes with its caveats, because FPI capital is just financial capital and it can move in and out very quickly. Um, while an Indian investor looks at India as their home market with India considerations, a foreigner who's allocating FPI capital has many different markets they can look at, and their reason to shift capital changes. For instance, if local interest rates in US rise and US AA bonds are giving you 8 9%, why would you take the risk of currency volatility and India market to earn 3 4% more in India? You'll not. So if a sharp movement happens, you'll move capital back. So I think too much FPI capital can be very volatile. I mean, if you look at Indian markets in 2008, I think FPIs had pulled out about 40,000 crores from the market. The market fell 50%, and all of us have very, very bad memories of that. The good news is, as we've been talking about on this conversation, today domestic capital is able to at least not match FPI capital in total size, but has grown a lot more meaningful. So our risks to being a market that is only reliable or reliant on FPI capital have reduced, which is a good thing.
Okay. So, uh, one particular question was, is the renewable energy sector expected to grow in the future as it has underperformed in the last 7 months? Was the subscriber question.
Oh, was firstly
Any
7 months is a little bit of a short span to look at this sector. Uh, and I
overall,
first
the renewable energy sector, how are you looking at it?
Look, I think India has made commitments to carbon net neutrality by the end of 2030. So, if you're asking me, is there a structural push to get there? Yes, there is a structural push to get there. I think the challenge to so I think the structural long-term question is not is not even one of debate, because all intent is to get there. Now, someone asked me this question in the context of autos. Will we move completely from auto to EV, traditional ICE to EV overnight? I don't think so. I think India's transition will take time, and we will probably operate in a hybrid environment. Recall that for most countries who are having conversations about renewable, their major tryst with development has happened. Their manufacturing thrust has happened. But in India, that process is still starting. So I always say, even in global context, when I'm asked about ESG, it's almost unfair to throw this thrust ke you become totally clean, you don't use coal when you haven't developed, and others have done all their development using the coal that they had to do. So I think the model will be hybrid, but it is work in progress. One thing that concerns us is that today the listed universe in terms of renewables is not a very large one. This is going to expand in terms of the number of opportunities that you have, because as investors you also need a good listed universe to participate. In fact, we were thinking of packaging one of these renewable or clean energy kind of solutions, and we haven't so far because we just think the listed universe is not good enough and wide enough to participate. So sometimes the theme may do well, the sector may do well, but you as an investor may not do as well because there are just not enough listed companies for you to participate in.
Okay. Just this one question, maybe it will capture the entire conversation. So, what would be the market scenario in the short and long term?
So I think the long term in India, if one had a decadal view, the long term is actually never even under question. I think the combination of consistent rapid growth, demographics, policy, digitization, I think makes India perhaps the most exciting major story over the next 20, 10, 20 years. And in the long term, to my point, as long as you see meaningful earnings growth and underlying profitability growth, that's going to translate into market growth. Now, for the short term, and investing is about seeing the long term by surviving the short term also. So both matter. I think the short term has a combination of things. Global markets continue to be volatile, although I think the tariff volatility will ease out, and hopefully after August 1st, we will have more clarity in this direction. Um, I think we are also seeing interest rate cuts that have happened in India, and perhaps another one is coming. So the uncertainty around rates is also getting better. I think the challenge we have from India is today markets are not cheap. Um, and when markets are not cheap, they tend to be very punishing if you don't grow. If you don't see an earnings growth rebound over the next couple of quarters, then I think you will have challenges to think about. So, what I would pay a close attention to is how India earnings growth shapes up over the next couple of quarters.
So the earnings season is underway, and so
Yeah.
far, are you satisfied with the earnings growth? Is it in line with your expectations?
I mean, it's not about our expectations. I think it's been a mixed bag, right? So there have been IT companies that have reported, and it's a little early into earnings season because we're just 1 month into it, and a lot of companies still have to report. But if you look at IT as a pack, I mean, most people have been disappointed, but I would argue that mid-cap IT companies have reported better than large-cap IT companies. In some places in consumption you are seeing the impact of a slowdown. So if you look at some of the, without naming companies, if you look at some of the both discretionary retail and staples, thoda sa disappointment hai. So we are hoping that this turns around in the second half of the year.
Yeah, ma'am. Sorry. So can we take live audience questions now?
Yes, go for it. So the question is, of course, challenges in the Indian economy, and is it RBI rate cuts that help, or more parameters to that? So of course, rate cuts help. I mean,
And
rate
I'll
cuts.
add a little more to the question, ma'am. So
Yeah.
there was this rate cut happening, and there was this tax cut happening, and a few more positive things that have been swept under the tariff confusion.
Uh,
So there is a hard date also, August 1st. So
yes.
you think these will come back into the equation? Obviously, consumption growth will come back into the equation, but you think the importance of these measures have been downplayed in the last 6 months because of the tariff conversation, confusion, everything?
I tend to agree, actually. It's an interesting question. I mean, I think that a lot of the noise that has happened in the last 6 months, because it is so public and there's messages on Twitter and X and it's global, I think tariffs have dominated a large part of the conversation. The reality, as said, while tariffs are one piece of the story, they affect the entire world. What really matters to India is how our domestic economy and domestic earnings shape up. And that, in my view, is going to be a function of how much liquidity there is, what the interest rate. So, for instance, RBI has done a lot to improve banking system liquidity. Very, very few comments are about that. Finally, you know, how much money is in hands of people to go out and spend, and I think towards that, tax cuts is a meaningful measure. So, I think finally, India equity growth is driven by India earnings growth, and India earnings growth will be driven by the fact that you drive up consumption demand. Now, a single measure, to the question here, a single measure will never be enough. So this is interesting. I mean, this was a sector that can be multi-baggers, and I think we've talked about this. I do agree there is a lot of churn happening. I mean, you talked about EVs and IT, but I talked about three sectors that were probably not in your questions, and that was
Hmm.
hospital, hotels, and
Okay.
capital markets. I think to your question, technological disruption, um, including driven by AI, is going to be a very, very interesting factor. Now, India is an economy where digitization and technology growth is happening at the same time as industrialization. And it can pose opportunities and it can pose problems. So if your IT companies, which started as outsourcing companies, have the ability to invest in AI, adopt to AI, be ahead of the curve, then perhaps it will be an opportunity. If they remain focused on coding, which is very, very automatable today, and I started my life as a computer science person, then there's a challenge. So I think for India, AI is both opportunity and challenge. And we'll have to see what it plays out. I am actually more, people are fairly critical of the IT sector. I'm actually more optimistic about it. I look at it this way: the IT sector in India started in the 1980s and it was given this tag of body shopping. From there to what it's become, I think the IT sector, like a cockroach, doesn't die. It showed the ability to adapt, to evolve, to change with times. And if it can do that, then hopefully, it will ride the AI crest rather than be hurt by that. But I
Okay,
think,
so if one were to say that the all the uh, uh, advanced stuff is happening in the unlisted space, at least with AI, then would that be a fair assessment or?
no, I don't think so. I think, there are unlisted companies in the AI space. One of them I know is going to be listing reasonably soon. So there is interesting stuff happening in the unlisted space. But don't forget that large listed IT companies are sitting on meaningful talent and cash reserves. So if they want to adapt, if they want to change, they also have the ability to do that. And in our portfolios, for instance, the whole mid-cap space of IT is a space that we have been reasonably optimistic about. We feel it's a sweet spot between not being too large, where growth could perhaps be a challenge, but also having the cash base and the experience to try and adapt.
So you will bat for the IT companies investing into
Yeah, I
new
mean,
age
we
technology
have been
because they
careful.
have been under the scanner that that is what they have not done in the last couple of years.
Yeah, we haven't written off IT in our portfolios yet.
Okay, fair enough, ma'am. That was a very useful discussion that we had, and I think your assessment that industrialization is happening along with AI and digitization, and this is the only economy where the three industrialization, digitization, and AI experimentation is going on simultaneously. That makes for a very interesting assessment of the Indian economy right now. And like you said, yeah, consumption is the primary driver for earnings that you have highlighted. And probably after all the noise of tariffs that plays out, maybe we'll see the earnings growth catch up with the consumption growth as well. Thank you, ma'am. Thank you for the time that you have dedicated for us. I think
Thank
our
you.
subscribers have greatly benefited from the conversation. Thank you, ma'am.
Thank you.